In this video, I'm going to cover the 5 mistakes that beginner investors make when they first start trading stocks. Now, as you can imagine, I spend a lot of time researching the markets and researching investor behavior, and I see so many beginner investors making big-time mistakes that could cost them in a big way over the long run. If you're relatively new to investing, I highly recommend watching this video. Now, if you're a more experienced investor, this video will serve as a great reminder or a refresh of what not to do. Now, obviously, there are a lot of mistakes and a lot of potential risks that come with investing, but these 5 mistakes are very important and often overlooked. Mistake number 1, don't short stocks. If you are an advanced investor or an advanced trader, you can feel free to ignore this rule. If you are not advanced, however, please pay attention to what I'm about to tell you.
Listen!
When we as investors typically buy a stock or an ETF or any investment for that matter, we buy it with the intention of the underlying security or investment appreciating in price. However, with short selling, you are betting on a stock's price to depreciate in value, and the biggest risk with short selling is that your risk or your potential loss is infinite. When we buy, let's say, $1,000 worth of Apple stock, our maximum loss is $1,000. Now, that's assuming the worst case scenario where Apple's share price goes to 0. But if we were to short Apple stock, our potential losses are infinite because Apple could hypothetically go to, $10,000 or even $1 million a share. When you're short selling, you are borrowing shares from your broker, and then you sell those shares on the open market with the hope that you can buy those shares back at a lower price and you return them to your broker, and then you pocket the difference as profit. The problem is if the stock's price goes way up instead of way down, you will more than likely be forced to buy back the shares at a much higher price. So unless you want to risk wiping out all of your money in a short period of time, don't short stocks. And believe me, people get wiped out all the time shorting stocks. Just do some research. There are countless numbers of stories of hedge funds and experienced traders getting burned short selling stocks. Mistake number 2, don't trade on margin. This one sort of falls in line with short selling because in order to short sell a stock, you will have to open a margin account with your broker. With margin, your buying power increases. Simply put, you'll be able to purchase more shares of a stock than you would normally be able to buy with just the cash that's sitting in your brokerage account. The first reason not to buy on margin is because your broker will charge you an outrageous interest rate. It's usually around 6 to 10% depending on your broker. Now, the second reason to not buy on margin is something called a margin call. When you trade on margin, you've introduced the possibility of a margin call. You see, when you trade on margin, you are essentially taking a loan from your broker by pledging the cash and existing securities in your account as collateral for the margin loan. But when you trade on margin and the value of your portfolio decreases below a certain threshold, you'll get what's called a margin call. And with a margin call, your broker will require an immediate fix. Now, you can do this either by depositing additional funds or liquidating your existing holdings. And margin calls can destroy your assets if you are over leveraged. So please do not trade on margin unless you are absolutely sure of what you are doing. Even then, the most experienced funds and traders can and do get destroyed trading on margin. Mistake number 3, don't trade stocks hitting 52-week lows. In almost every case or scenario, you are better off buying a stock that's hitting a 52-week high than a stock that's hitting a 52-week low. Stocks like these are often referred to as value traps. You may think they're a really great deal, but I'm here to tell you that there's a reason the stock is hitting a 52-week low. You see, misery comes in battalions, and from my experience, I've never really had much luck buying a stock with downward momentum. Sure, there are some cases when you can buy a stock trading at a 52-week low. I mean, maybe a company has a new management team, or maybe they were trading at an all-time low due to a regulatory issue that's now been resolved or lifted. But in most cases, I highly suggest you stay away from stocks that are trading at 52-week lows.
Run away, yeah, run away.
Mistake number 4, Avoid penny stocks. A penny stock is any stock that is trading below $5 a share. And again, unless you are an advanced trader, stay away from penny stocks. Many times people start trading penny stocks because they may only have a few $100 or maybe a few $1,000 to trade. And I think there is this misconception that if you don't have tens of thousands of dollars, you don't have enough money to trade, companies like Facebook or General Motors or Amazon. And that's just not true, especially with the availability of fractional shares on brokerages like Robinhood. You can buy any company's shares with as little as $1 in your account. Low-price stocks are typically correlated with low-quality companies. Additionally, penny stocks are much more volatile than higher-priced stocks. Now, I find that many beginner investors look at the market in terms of dollar amounts and not in terms of percentages. What I mean is that a $100 stock that loses $1 of its value in a day is not the same as a $2 stock that loses $1 of its value in a day. I mean, the $100 stock lost 1% of its value, and the $2 penny stock lost 50% of its value. It's not the same thing at all. So stop thinking about the markets in terms of dollar amounts. Start thinking about the markets in terms of percentages. And with penny stocks, you also have the issue of liquidity, where you can get stuck with a stock and not be able to sell it for hours or maybe even days. So unless you are absolutely well-versed and know what you're doing, do not buy penny stocks.
Say no more.
The fifth biggest mistake people make is trading other people's ideas. I see this happen so much in my life, and every time I see someone buy a stock or a cryptocurrency solely based on the fact that their Uber driver or someone at the gym or someone at a party told them to, it just makes me cringe. Now, unless your workout partner is an analyst at a hedge fund, please don't buy stocks or make any investment solely based on someone else's suggestion. Number one, you don't know if that person actually owns that stock or investment. I mean, they could just be putting on a front by saying they made $10,000 on Bitcoin or they made $5,000 trading Microsoft stock. You just don't know. Secondly, you need to develop the conviction to buy something on your own because no two people are alike in their risk tolerance and their investment style. I mean, it's totally okay to bounce ideas off of your friends or your family, and I'm not saying don't do that, but there's nothing like developing your own conviction when investing. I highly suggest that you go out and do your own research. Find out what you want to pay for a company. Determine what your risk tolerance is and where you want to put a stop loss in. Trust me, once you do your own research and develop your own investment style, you'll use other people's ideas as a tool to aid your investment decisions, not as certain investment advice.
Say no more.
The fact is that no one on this planet is a perfect investor. You are going to lose money and you're going to make money and you're going to miss out on great investment opportunities. I mean, even the countless people who come on CNBC and write for Forbes and write in the Wall Street Journal or are analysts at a big bank don't know everything. I mean, I can't tell you how many analysts at banks that cover a certain stock are just wrong. I mean, even Warren Buffett, as great as he is, totally missed out on the tech trade by refusing to add Facebook and Amazon and Apple and other tech stocks to his portfolio. With that, we're going to call it a video. I hope you all found today's video helpful. I made it with the genuine intent to show you the mistakes that beginner investors make. Now, if you like this video, please hit that like button. And if you like the content on my channel, please remember to hit that subscribe button. Thank you all for watching. I'll see you next time.